Ever felt fed up with your so-called 9 to 5 job, sick of office politics, endless meetings, and you feel that you deserve more? Maybe you've been thinking, why not just trade for a living? I'd be my own boss, set my own hours, travel the world, and trade from anywhere. No boss to answer to, no corporate nonsense. Wouldn't that be a perfect life? Sounds almost like Anil's story from the dark side of trading education episode, right? Very high chances that you had these thoughts. Or at least you've seen someone on social media selling that dream to you. That influencer trading from the beaches of Goa, promising you that you can swap your cubicle for cocktails by the ocean and a Lamborghini in the driveway. But here's the truth. I can't tell you much about Lamborghinis, and I definitely don't know much about trading from the beaches of Goa, but what I do know is trading itself, how it really works, and whether you can actually generate an income from it. And that's exactly what we are going to talk about today in this episode. I'm your host Sandeep Rao, and this is an episode about should you become a full-time trader. As with anything else, we first need to define our terms to set the stage. So what exactly do I mean by full-time trading? When I say full-time trading, I'm talking about generating returns from your capital after costs in a way that not only covers all your living expenses, but also leaves you enough to save for the future. In other words, your entire livelihood depends on the profits you make from trading. You're not drawing any salary, business income, or side hustle. Trading is the only thing you do and the only stream that feeds you and your family. On the other side is part-time trading. Here your expenses are covered by something else, your job, your primary business, or maybe you have multiple sources of income. For you, trading is an additional layer on top, a way to build wealth or pursue opportunity, but not the thing that you rely on to get your rice or roti on the table. In this episode, we are going to focus on all the issues around full-time trading. What does it actually take to make it happen? And more importantly, what does the journey look like if you choose to go down that path of becoming a full-time trader? And equally important, if full-time trading isn't the answer, what realistic alternatives exist for someone who still wants to trade seriously? Now that we have defined full-time versus part-time trading, let's move to the next concept we need to be clear about, and that's trading as a business. I stress this because when we talk about trading, we have to treat trading as a business and not as a hobby or a side hustle. It's similar to any other business. You need capital and you need to take risk on that capital. And then there is a cost attached to deploying that capital. And therefore, the returns aren't really profits until the returns cover the costs and taxes. And lastly, like any other business, there is always the risk of ruin, an uncomfortable but unavoidable reality that we can't afford to ignore. Now, for a moment, let's step aside from trading and think about something more familiar. Say you want to open a restaurant or a cafe. Chances are you'll need to borrow money and bring in investors to get started. Now, there are two possibilities. Either you have some experience in the food and beverage space, or you're completely new to it. If you have experience, you already know a fair bit about what works and what doesn't. You've probably seen enough to identify a niche and position yourself accordingly. But let's assume you're a total newbie. What would you do next? Naturally, you would want to understand how the business actually works. How do you go about that? One, you might talk to a few cafe owners to learn from their experience, or better still, you may work part-time or full-time in a cafe to learn the ropes. But one thing is sure, you would not attend a weekend workshop where someone promises you to teach everything you need to know about running a cafe. And this is where I want to introduce one of the first but important concepts, and that is proof of work. To increase the odds of your success in any business, there has to be evidence, proof that you have built some experience, demonstrated some understanding, and shown that you can handle the basics. That's exactly what investors or banks would look for before giving you the capital. Would you put your money in a cafe run by someone with zero experience in the industry? Probably not. If you are thinking about full-time trading, the first and the fundamental question to ask yourself is, do I have the relevant experience to show as proof of work? Many people assume trading is an easier business than most others, and that assumption becomes the mother of all sorts of problems. Which is why I want to dig deeper into it. Why do people make this assumption in the first place? And why is it so dangerously misleading? From my experience, there are two big reasons. The first is low barriers to entry. Barriers to entry simply describe how easy or difficult it is to start a business. Think of it like the ease of doing business rankings that countries get, which help investors judge how friendly or hostile an environment is for starting a business in a given country. But here, I'm using the term at a more personal level, how easy it is for you as an individual to get started in a business. Now let's continue with the cafe example and compare it with trading. Starting a cafe means raising capital, scouting for a location, signing a lease, doing up the interiors, hiring and training staff, managing suppliers, and getting all the licenses, and I'm sure that's still not the full list. By contrast, opening a trading or investing account takes just a few minutes, a few clicks on the phone, and voila, you are in business, or so you think. In trading, all you need is a phone and a broker account, and suddenly it feels like you're just one secret away from making money. But with the cafe business, the barriers are obvious. Rent, staff salaries, licenses, supply chains. Nobody believes they can run a profitable cafe after a weekend workshop, but with trading, they do. And that's the point I want to make here. Low barriers of entry does not mean high chances of success. The second reason is what I call illusion of ease. People often assume trading offers a relaxed routine, show up at your desk when the market opens, make some money, be done by 3:30, and you're free to spend the rest of the day on any other interests that you have. Running a cafe, on the other hand, doesn't carry that illusion. It's obvious you'll have to be up early in the morning to prep, managing suppliers and staff till late in the evening, and repeat all of that next week, day after day, including weekends. In fact, weekends are your busiest day. Now, who really wants that grind? But you know what? The reality of trading is no less demanding. It just hides the effort in different places. What do you do when you hit a string of losses? How do you pay your bills if you're net negative for months on end? You may not need to keep the shop open till midnight, but your trading positions can keep you awake all through the night and over the weekends too. These are the realities that illusion of ease hides. Put simply, the combination of low barriers to entry and the illusion of ease creates a false impression that trading is somehow simpler than other businesses. But if success in trading was so easy, why would so many people struggle to run cafes or any other businesses where hard work is so evident to see? Maybe they are not the smartest of folks? Next, let's talk about leverage, something that's key to almost every business, including trading. At its core, leverage is simply borrowed money. Every time you take a loan to buy something, you're using leverage. Think of it this way. You buy a car worth 10 lakhs by making a down payment of 2 lakhs. In effect, now you literally control an asset that's 5 times the value of what you actually paid. That's leverage. If you are in the cab business, that leverage allows you to earn from an asset worth 10 lakhs while putting in only 2 lakhs of your own money. Of course, you also carry the cost of borrowing. That interest is the price you pay for using leverage. You do something very similar in trading. In fact, all derivative products are designed to offer leverage. And yes, it's a double-edged sword, and you'll soon know why. Let's go back to our example. You put in 2 lakhs to control a contract worth 10 lakhs, and that's 5x leverage. Now, if the stock moves 5%, that's a gain of 50,000. On your 2 lakhs, that looks like a 25% return. Sounds exciting, right? But the same math works in reverse. If stock falls 5%, you are down 25% of your capital in a single move. And here's the key difference from other businesses. If your cafe is affected by floods or such disasters, you can buy insurance to cover yourself. If your cab gets into an accident, again there is vehicle insurance. In trading, it's not so simple and straightforward to insure your positions. You need to have the discipline in position sizing, in hedging, and in risk management. Without it, leverage can wipe out your capital in ways that are impossible to recover from. Okay, so far we've talked about proof of work, low barriers to entry, the illusion of ease, and the impact of leverage. Taken together, these should give you a broad view of what trading really looks like when you treat it as a business. Now let's move to the next big thing, and that's capital. At the end of the day, no business runs without capital, and trading is no different. To make this real, let's walk through an example. Suppose your annual cost of living is 12 lakhs. The question then is, how much trading capital would you actually need to generate that as an income after considering all costs, taxes, and risks? Like we did in episode 2 of The Long and the Short, where we asked how much can you realistically make through trading, let's anchor ourselves to 2 baseline references. The first is a fixed deposit that gives about 6.5% return per annum. The second is Nifty 50, which has delivered roughly 12% CAGR over the long term. Using these two benchmarks, you'd need around 1.85 crores in an FD and 1 crore in Nifty to generate 12 lakhs a year. All of this is pre-cost and pre-tax. Also remember, investing in Nifty won't guarantee returns at the end of a given year. 12% is an average. It's quite possible that you may have negative years as well. If you are going to be actively trading, you'll obviously need to make more than these baseline numbers. I am not even factoring in the opportunity cost of your time. With an FD or an index investment, those returns come passively. You could be doing a job or running a business on the side and still earn those returns. At this point, I want to check with you if you're still with me, and hopefully you are not completely disheartened by the idea of full-time trading just as yet. And if you are, that's okay too. Now you might be wondering, how do I generate returns higher than the baseline returns of an FD or Nifty? This is where the concept of pledging comes in. Imagine you have 1 crore, you could park it in a liquid fund, a debt product that offers returns similar to an FD, or invest in an index ETF or a mutual fund. Then instead of just letting it sit, you pledge it. But what does pledging do? It allows you to borrow against your holdings. Typically, around 80% of the pledged capital becomes available as margin for you to trade with. Going back to our 1 crore example, once you pledge it, you get around 80 lakhs of trading margin. But here's an important detail. You can't use this margin to go out and buy more stocks and hold them for as long as you want. How you use the margin has some restrictions, depending on the holding period and the product in question, that is equity versus F&O. Typically, you can use all the margin if you are trading intraday and go up to 50% if you are holding a position overnight. Now let's zoom out a bit and take a couple of scenarios to see what happens when you trade with 80 lakhs of margin. Suppose you deploy the entire 80 lakhs into futures and options for intraday trades. With typical leverage of around 5x, that means you're controlling positions worth about 4 crores. Of course, you don't have to use it all. I'm exaggerating here just to illustrate a point. Now imagine those positions move against you just by 5%. On 4 crores, that's a loss of 20 lakhs. Relative to your 1 crore, that's a 20% drawdown from a fairly small market move. And here's the thing, when you book your losses, your margin and exposure also shrinks. With 20 lakhs gone, your margin drops to 64 lakhs and your max 5x exposure drops from 4 crores to 3.2 crores. Which means now to claw back those 20 lakhs of 5% on original 4 crore exposure, you'd need roughly 6.25% gain on the reduced 3.2 crore exposure just to get back to even. That's the asymmetry of losses. Losing is always faster and steeper, and making it back takes disproportionately more effort. Let's consider a positive scenario. Suppose you are able to generate an additional 5% a year through trading on top of your 1 crore base invested in liquid funds. That brings your total returns to about 11.5% annually, which works out to roughly 11.5 lakhs a year before costs and taxes. Not bad actually. So far we've covered proof of work, low barriers to entry, the illusion of ease, the impact of leverage, how much capital you'd actually need, and the idea of pledging. Now comes the fundamental question you need to ask yourself. Is that extra 5% really worth your time? And please, don't tell me you can do much more than that unless you have solid proof of having done it consistently over long periods of time. Because let's be honest, if you had, you wouldn't be watching this video. Think about it this way. Even if you're serious about generating that extra 5% over your pledged capital, you don't necessarily need to sit in front of a screen all day staring at charts. A lot of it can be automated today. Your time is almost always better spent on a career or a business where you can truly leverage your skills and competence. And if the markets still hold that irresistible pull and you want to spend your days and nights solving market-related problems, then consider building a business around markets or take up a role in the capital market space. That way, you earn from your investments and you get to work in a field you're passionate about. Either way, devoting all your time just to squeeze out a small percentage of alpha on top of your capital is rarely the best use of your time and energy. And here's my honest observation. Over years, I've consistently seen that people who trade on the side often outperform those who try to make it a full-time job. So here's a summary of all that I have been talking about. Trading in the stock market suffers from a perception problem. Compared to other businesses, it feels deceptively easy, and that's thanks to the low barriers to entry and an illusion of ease. Yes, generating alpha on your capital, whether it is in debt or in equity, is possible. Don't get fixated on the 5% number that I shared. In reality, it could be more or it could be less, but that's not the point I'm trying to make over here. If you are serious about trading, here are 3 things to keep in mind. First, plan to spend at least 5 years building some form of proof of work. Trade small, experiment with multiple strategies, and most importantly, do it on the side, while your primary job or business continues to pay your bills. While 5 years may seem like a long time, but it's just enough to give you a realistic sense of what's possible in this space. 5 years of trading would give you an opportunity to experience many event days, like budgets, RBI rate announcements, maybe the impact of election results, and all of that. It's important to get a real feel of how the market reacts to all these events while being invested in it. Nothing much can be gained by watching it from the sidelines. Second, the fact is you'll need significant capital, and if you're wondering what is that minimum number, I cannot give you a single number. Instead, I'll urge you to work it out yourself. Start with your monthly expenses, then calculate what percentage return you need after costs and taxes, and of course, to cover all the expenses and still survive. That figure will look different for everyone, which is why there is no one universal magic number. Last and third, consider the opportunity cost of your time. Do you really want to spend all your days staring at charts, especially when in today's world a lot of trading can and should be automated? That's not only a possibility, but that's the future indeed. And with that time freed up, ask yourself, would you still want to do nothing but trade, or would you rather build a long-term career or business? That career or business could very well be in capital markets as well, if that's where your passion lies. I hope you found this perspective useful. Share your thoughts in the comments and I'll do my best to respond. Thank you for watching, and always be careful with your capital.